Hi, Assalamualaikum everyone. We are from Group 8 and we will be presenting our research on one of the well-known fraud case, the Lehman Brothers. Our group consists of 2%, which is myself, Amir Zakwan bin Baru, and my partner Muhammad Azul Haikal bin Zulkarnain. Now, without further ado, I will proceed our presentation started with the introduction of the case. The Lehman Brothers Holding Incorporated originally was a global financial service from a firm operated in 3 business segments. The first one is capital markets, investment banking, and investment management. They providing a full service in equity and fixed income sales, trading and research, investment banking, and etc. Originally founded by 3 German brothers, Henry, Emmanuel, and Lehman, in Montgomery, Alabama in 1844. At the first, they only focused on selling groceries to cotton farmers until they evolved their business to becoming a global financial service firm. The company had headquarters not only in New York but also in London and Tokyo. Throughout its history, the firm had survived various challenges until they finally becoming an independent public company in the year 1994 due to a spun-off by American Express in initial public offering (IPO). Around this time, the leadership's role of Richard S. Feld Jr. as the CEO, leading the firm's expansion in global financial markets. However, the Lehman Brothers faces a severe test during a global financial crisis. The firm was filed for bankruptcy on September 15, 2008, marking one of the largest bankruptcies in the United States history. The firm, once considered too big to fail, also collapsed to mounting pressures and challenge. The event that took place at Lehman Brothers Incorporated shook the foundation of the financial industry, which leading to questions about transparency, corporate governance, and the regulatory landscape. The collapse of Lehman Brothers had far-reaching consequences, triggering a panic in financial markets, freezing credit markets, and contributing to the severity of the global financial crisis. The event prompted widespread discussions about financial regulations, risk management, and the interconnectedness of the global financial system. Now, let's move on the next slides, which we will elaborate more in the case with a further explanation. The tone of the top. What is the tone of the top? It is a company culture and ethical values which are established by the top management, including the CEO, CFO, and other executives. These leaders play a key role in shaping the overall directions and management of the company. They are also encouraging employees to report potential fraud or unethical behavior, which is crucial to prevent any fraud. So, in the case of Lehman Brothers, CEO Richard Feld established an aggressive and risk-tolerant culture. He also known for his assertive leader style, was perceived to encourage a culture that prioritized short-term profits and market share gains. Feld emphasized on meeting quarterly financial targets and sustaining rapid growth set the stage for a risky and unsustainable business model. This overall tone at the top contributed to a culture that may have a downplayed risk associated with the housing markets and complex financial instruments. Next is the asymmetric information. Asymmetric information occurs when one party possesses more or superior information than the other, which leading to potential deception and moral hazards. While in the case of Lehman Brothers, financial statements were very unclear and inaccurate in revealing the risk linked to its substantial investment in mortgage-backed securities during the housing market decline, and it affects the external users. Investors and stakeholders operated in incomplete information, unaware of the true extent of Lehman's vulnerability. The lack of transparency about the value and risk of these assets mean that the insider had better knowledge about the firm's financial health, leading to a lack of confidence in the accuracy and completeness of information available to external parties. Next is the role and responsibility of board directors. The role is very simple. The BOD have to safeguard the interests of shareholders and stakeholders. They must responsible for providing strategic directions. They have to evaluating executive performance and ensuring that managerial decisions align with the organization's long-term goal. While in the case, the CEO Richard Feld, the board himself allegedly breached the fiduciary duties by not adequately challenging management decision, exposing the company to risks related to mortgage-backed securities in the housing market. So, the case underscores the crucial role of board in ensuring strong corporate governance and safeguarding stakeholders' long-term interests. Furthermore, which is the human bias. What is human bias? Is a tendency of individuals to act or make decisions for the benefit of only themselves. According to adjacent theories, an individual's self-interest or desire to maximize their personal benefits regardless of the impact of the principle. While in the Lehman Brothers case, Richard Feld used Repo 105 transaction to temporarily move assets off the balance sheet, creating a misleading impression of improved financial health. This strategic decision, driven by the executive biases, aimed to manage the perceptions of the firm's risk exposure and financial stability. Now the last one is fiduciary duty. The Lehman Brothers Board of Directors faced scrutiny for alleged lapse in risk management and transparency following the firm's 2008 collapse. Entrusted with safeguarding the company's and shareholders' interests, the board failed to fully meet its fiduciary duties by not effectively questioning management decisions. This includes substantial exposure to risky financial instruments and the use of Repo 105 transactions, which obscured the firm's true financial standings. This perceived failure underscored the crucial role of a vigilant, independent board in upholding fiduciary duties and ensuring the long-term viability of the company and protection of the shareholder interests. The Lehman Brothers case prompted discussions on governance reforms and regulatory enhancements in financial industries. So now, let's go to the next segment, which is how the fraud was perpetrated and concealed. Before that, I will explain to you guys how it all started. Actually, there's a story behind it. Okay, this firm was very well known with the name of shadow banking system. Okay, the company resorted to tactics to extend its financial standing. It surpassed its internal risk thresholds and manipulated its liquidity pool by incorporating encumbered assets. Furthermore, the company adjusts its internal stress test by excluding specific high-risk assets. Notably, the company increased its reliance on a specific type of sale and repurchase repo transaction referred to as Repo 105 to manipulate its balance sheet and net leverage ratio, creating a more favorable appearance than the actual situation. Then the company adopted a highly leveraged business model, necessitating the daily procurement of billions of dollars for its operational needs. Like the majority of the investment banks, but it heavily depends on the unregulated short-term wholesale funding provided by the commercial paper loans and repos utilized by investment banks, hedge funds, and other institutional investors. Yes, so that's how the problem, which is the main reason why everything collapse, everything corrupts begins because of the Repo 105. So let's proceed to the next slide. Continue. So after that, what happened to the company? So what happened was that the total liabilities and the debts of Lehman Brothers at the time of its bankruptcy were very enormous. The firm reported approximately $639 billion in assets and $613 billion in liabilities in its bankruptcy filing. At that time, Lehman was the fourth largest United States. Largest in the United States, So, to the question, who is the one pulling the string? Of course, is the Richard Feld, a central figure in the decision-making process, create a misleading representations of the firm's financial health by manipulating the Repo 105 transactions. What are the outcome? The company significantly escalated its reliance on Repo 105 transaction during late 2007 into 2008, removing as much as $50 billion of assets from its balance sheets at the quarter end. Impacts its publicly reported leverage ratio. And what are the effects to external users? The consequences of this action was a loss of confidence in Lehman Brothers among investors and regulators, leading to its historic bankruptcy, filing in September in 2008. Now, we will talk about who is the whistleblower in the Brother Lehman's case. There are two persons. The first one is Matthew Lee and Anton Arvalukas. Matthew Lee is a former senior vice president at Lehman Brothers in 2008. Matthew Lee raised red flags regarding Lehman Brothers, the usage of a financial maneuver known as Repo 105. He took his concerns to external regulatory authorities, including the Securities and Exchange Commissions (SEC). So what happened was, in May 2008, Matthew Lee penned a letter to senior management, cautioning about potential masking of risk on the firm's balance sheet. However, a month later, he was ousted. He was being denied, ignored. This warning disclosed in a report by a US bankruptcy court examiner. It revealed that Lehman's auditors were aware of the possible accounting irregularities, but the auditor allegedly did not bring the matter to the attention of Lehman's board, underscoring lapses in oversights and finally contributing to the unfolding financial crisis. The next one is Anton Arvalukas. He is a prominent lawyer, or was a former US attorney, and he was appointed by the US Bankruptcy Court for the Southern District of New York. The report of Anton Arvalukas examiner provide detailing insights into Lehman Brothers' action, financial practices, and decision-making processes leading up to its bankruptcy in September 2008. What he did was, he revealed vital insights into the misapplication of Repo 105 transaction and the lack of required disclosure. The report emphasized the flaws in Lehman Brothers' internal control, the limitation of external auditors, and regulatory oversight failure that allow these errors to continue. So, in the findings of the case serve as a stark reminder of the importance of a whistleblower and external investigations in holdings corporations accountable for their financial practices, promoting transparency and safeguarding the integrity of financial markets. The aftermath of Lehman Brothers collapse spurred these discussions on regulatory improvements and mismanagement practices to prevent similar crises in the future. That's all from me. I will pass to Muhammad Haikal to continue our presentation.
Hello, Assalamualaikum and hi. My name is Muhammad Zuhaikal bin Zulkarnain and I would like to continue this presentation. Okay, for the next slide is what could have led to the fraud. There are three things that would lead to fraud, which are pressure, opportunities, and rationalization. First, for the pressure, the company had to maintain an advantage over its competitors and present a picture of stability and financial strength. Next, for the opportunities, the adoption of complex financial products such as mortgage-backed securities presented potential for accounting fraud. And the last is rationalization. Lehman Brothers justified its aggressive financial tactics by balancing market rules, industry culture, historical precedents, and strategic concerns. The pressure, opportunities, and justification listed above are unacceptable justification for fraud, and those who engage in fraudulent acts should be held legally liable for their action. Organizations should also have strong internal control, ethical corporate governance procedures, and also a culture of transparency and responsibility to effectively prevent and identify fraud. Next, for point number 4 is the consequences, effect, penalty imposed. One prominent instance of financial misbehavior and company collapse that has dire repercussions for many parties involved is the Lehman Brothers case. The 2008 collapse of Lehman Brothers was a major factor in starting the world financial crisis. Here are the consequences, effects, and penalty imposed on different parties. For the first point is auditor. Ernst & Young was a Lehman Brothers external auditor, was facing a number of consequences and inquiries following the Lehman Brothers case. However, it is crucial to remember that E&Y was not directly sued for Lehman Brothers' demise. Ernst & Young are facing reputational damage Ernst & Young's reputation suffered greatly as a result of its involvement in the failure of Lehman Brothers. One of the main causes of 2008 financial crisis was Lehman Brothers' collapse, and Ernst & Young auditing role highlighted the company's inability to properly review Lehman financial statement. Other than that, increased regulatory scrutiny. Even though Ernst & Young was not directly sued, the Lehman Brothers case raised regulatory concerns about auditing procedures generally, the efficiency of auditing standards, and the function of auditor in identifying and avoiding financial irregularities were revealed by regulators. For the next part is company. The company faced bankruptcy. The most significant consequences for Lehman Brothers was its declaration of bankruptcy on September 15, 2008. This event marked one of the largest bankruptcy in US history and had profound implications for the global financial system. Next, caused the employee layoff. The bankruptcy resulted in a massive downsizing of Lehman Brothers, leading to thousands of employees losing their job. The collapse of Lehman Brothers has a ripple effects on employment across the financial industry. For the management part is the top executive, including CEO Richard Ford, experienced reputational damage. The collapse of Lehman Brothers became a symbol of corporate failure and risk mismanagement, and the management team was widely criticized for their role in the event leading up to the bankruptcy. The management team became the target of numerous lawsuits from shareholders, creditors, and other stakeholders seeking damage for the financial loss incurred due to the collapse. Some of these lawsuits result in settlements, further impacting the financial standing of the former executive. The Lehman Brothers case, along with other corporate scandals, led to increased scrutiny of corporate governance practice. It prompted discussion about the need for stronger oversight, risk management, and accountability at the executive level. For the shareholders' part is financial loss. Shareholders of Lehman Brothers incurred substantial financial loss as the value of the company's stock plummeted. The bankruptcy led to a near total wipeout of shareholders' value, resulting in a significant reduction or complete loss of their investment. Next, legal action and class action lawsuit. Some shareholders initiated legal action and class action lawsuits against Lehman Brothers, its management, and in some cases, the auditors. Shareholders sought compensation for their loss, alleging inadequate disclosure of the company's financial risk and mismanagement. Next, loss of confidence in financial markets. The collapse of Lehman Brothers contributed to a broader loss of confidence in financial market. Shareholders, as well as investors at large, become more risk-averse and skeptical about the stability of financial institutions, influencing investment decisions and market behavior. And next, for the last part is any relevant parties. The 2008 collapse of Lehman Brothers affected a great number of individuals, not just investors, management, and auditors, but also other financial professionals. A great deal of money was lost by those who borrowed it from Lehman, and workers in financial jobs across were impacted by the unexpected problems. To stop a larger issue, the government has to intervene. The globe saw that borrowing money get more difficult, investing become riskier, and many individuals lost their job. Large investors and pension funds lost money, and even average individuals found it more difficult to purchase property. Following this, people faith in bank and finance decreased. It altered global money practice and strengthened regulation to prevent future occurrence of this kind. In conclusion, the 2008 Lehman Brothers case had a significant impact on the global financial system. It demonstrated how poor risk management by certain institutions and auditors contribute to the world financial crisis. The globe was affected by the issues that the management, investors, and auditors had to deal with. Government and authorities tightened regulation in the wake of Lehman Brothers to prevent similar problems. It served a reminder that sound money management and ambiguous relations are essential to a sound financial system. From my perspective, the Lehman Brothers case underscores the critical importance of responsible financial practice, robust risk management, and effective regulatory oversight. It draws attention to the necessity of accountability and openness at all financial system levels in order to avoid systemic breakdowns that might have dire economic repercussions. Significant regulatory changes were brought about by the Lehman Brothers crisis, creating a more robust financial system and reducing the risk connected to big financial firms. It functions as a warning story, highlighting the ongoing significance of cautious financial management and watchful supervision to preserve the integrity and stability of the world financial system. Next, for point number 6 is what we have learned, and please state one wisdom that something interesting about this assignment. The main lesson that we have learned from the Lehman Brothers case is that we should all need strong rules and careful management to keep our money system safe. Aside from that, we need for openness and prudent money management is the lesson. It emphasizes how important it is for business, auditors, and regulators to actively manage risk, to be transparent about their financial status. The wisdom here is that everyone involved, companies, regulators, and even the people running the business, must work together to be honest, follow the rules, and manage risk well. This helps avoid major financial catastrophes that might harm not only specific business but also the global economy as a whole. To maintain stability, it is crucial to monitor the handling of money and ensure that everyone stays by the laws.